Hey guys, hope you are doing well and welcome to another new video. And this is Armanilo. In our previous video I talking about the benefits and drawbacks when applying for insurance and loans, and this video I talk about you the dark side of loans insurance and how to avoid super charges. uh, so I hope you guys enjoy all the video, and you guys enjoy all the video but you don't subscribe our YouTube channel. Please subscribe our YouTube channel, get more video like this. So guys, this video is so informative. I'll so excited started this video. So guys, let's start this video. Okay, today we know the dark side of loans. The dark side of universal banking loan. Since the subprime financial crisis began in May 2007, banks and insurance around the world have reported as 1.1 trillion US dollar of losses. 17 large universal banks accounts for more than half of those losses, and 9 of them either failed or nationalized or were placed on government funded life support. To prevent the collapse of global financial markets, central banks and governments in the US, UK, and Europe have provided 9 US dollar trillion of support to financial institutions. Okay, then we know the dark side of dark side of bank loan. The global economy is currently experiencing the most severe financial crisis since the Great Depressions. The ongoing crisis has battled global financial markets and has triggered a worldwide global stock market values declined by 35 US dollar trillion 35 trillion US dollar during 2008 and early 2009, and global economic output is expected to fall in 2009 for the first time since World War II. In the United States, where the crisis began, markets for stocks and homes have suffered their steps downturn since the 1930s and have driven the domestic economy into a slip and prolonged recessions. The total market value of publicity trade US stock stamps by more than 10,000 trillion from October 2000 through February 2009. In addition, the value of US homes fell by estimated 6 US dollar between mid 2006 and the end of 2008. US gross domestic product declined sharply during the second half of 2008, and 4.4 million jobs were lost during 2008 and the first 2 months of 2009. In early 2009, the US appeared to be trapped in a vortex of plunging customer demand, rising joblessness, and a deepening crisis in the banking system. Uh, okay, by March 2009, the continuing collapse in financial markets around the globe reflecting an absence of faith in the ability of governments and regulators to deal with our financial crises. The turmoil in financial markets reflects deep concerns among investors about the viability of major financial institutions, commercials and investment banks and insurance companies around the world report more than 1.1 US dollar trillion of losses between the outbreak of the financial crisis in mid 2007 and March 2009. In response to those losses, and to prevent the collapse of the global financial system, central banks and governments in the United States, United Kingdom, UK, the Europe provide almost to 9 US dollar trillion of support in the form of emergency liquidity assistance, capital infusions, assist purchase programs, and financial guarantees. US federal agencies extended about half of the support. Nevertheless, the ability of global financial markets to recover from the present crisis remained in serious doubt in April 2009. 17 large universal bank account for more than half of the 1.1 US dollar trillion of losses reported by the World Banks and insurance companies. 12 of these universal banks suffered serious damages, including 6 institutions that failed or were nationalized to prevent their failure, and there are 3 other institutions that were placed on government funded life support. Okay, during the past two deciders explained in parts 2a, a massive consideration and within the financial service industry, the German Lichbailey, the German Lichbailey Act of 1991 was a prominent domestic example of the international regulatory trend of favor universal banking. Then we see that the re-entry of commercial banks into serious markets. The Banking Act of 1930 built a legal firewall that separated commercial banks from the securities industry. During the 1980s and 1990s, federal regulators opened loopholes in the glass steagall wall in response to growing competitive pressures in the financial marketplace. In 1987 and 1989, the Federal Reserve Board allowed bank holding companies to underwrite debt and equity securities to a limited extent by establishing sessions 20 subsidiaries. During the 1990s, the FRB progressively relaxed its restrictions on sections 20 subsidiaries. By 1997, those subsidiaries could complete effectively with securities firms for underwriting mandates. In response to the FRB orders, many large domestic and foreign banks established sessions 20 subsidiaries, often by acquiring small and mid-sized securities firms. By mid 1998, sections 20 subsidiaries were owned by more than 45 banking organizations, including all of the 25 largest US banks. Okay, guys, we see that there are many dark side of loans insurance, and we also this topic see how to avoid supercharges. And last we know that this things is neglect, and this is to avoid supercharges. Guys, this video is helpful to and interesting, informative to you. Please like this video and comment this video, and share your friends, and subscribe to our YouTube channel.